Markets change. The unknown unknowns are what move markets, while the known unknowns are already priced in. Declines happen, but history shows they've all been temporary. The advance is what's permanent. I'm Mike Bishop.
And I'm Michael Bishop.
As fiduciaries, with decades of combined experience, we've helped investors navigate the noise with a disciplined, long-term plan. The key to success is acting on a strategy, not reacting to headlines. Welcome to the Fiduciary's Edge, where we break down the risks, opportunities, and realities of managing wealth the right way. Let's dive in. All right, welcome to our last podcast of 2025 before we go into the new year and have a whole new series launched. I'm Mike Bishop.
I'm Michael Bishop.
And we're going to do some touching on a few things we've talked about and where they stand today.
That's right. Just wanted to recap some big topics for the year, recover some questions that we got from clients throughout the year, big things in the news media that everyone was talking about, and we'll do one final pass on cryptocurrency for 2025 as well. First things first, at the top of the list, what we wanted to talk about first is tariffs. Thing on everyone's mind at first glance for us. What is a tariff? Because I think there's so much confusion about what they are. And I think even as of this week, the Treasury Secretary, Scott Bessent, was on Capitol Hill being grilled by Congress members, and he couldn't give a direct answer about to the question, who pays the tariff?
Yeah.
And I think personally he was dodging, not that he doesn't know, but either way, what is a tariff? And I can remember, burned into my skull, 8th grade social studies class. I literally remember that was one of the first vocab words for the chapter 1 of that 8th grade section was tariff, a tax on imported goods. Okay, what does that mean?
I didn't get that until college. You got it in 8th grade.
Yeah, but what does that mean then? What is a tax on imported goods? And just to give a real basic example of this, let's imagine that you are making Nike sneakers in China. You are a firm in China manufactures Nike sneakers and wants to sell those sneakers to anyone who will buy them in China, outside of China, wherever.
Okay.
Let's say then that you are a consumer in the United States wanting to buy Nike sneakers. To get the sneakers to the shelves where you're going to buy them, they had to get there from China.
Right.
So very mechanically, how a tariff works is the producer of those sneakers puts them on a boat in China. So somewhere along the east coast of China, maybe Shenzhen, the boat is loaded up with Nike sneakers, makes its way across the Pacific Ocean, and lands somewhere on the west coast of the United States, Seattle, Los Angeles, somewhere like that. When that ship arrives in harbor, the crew or the captain or someone will provide the harbor with a list of everything that's on that boat. That's called the manifest.
Okay.
Because a container ship, if you can think of that in your mind, it's like a skyscraper loaded with metal boxes that you can't easily see into. So to get a sense of what's coming into the country, a customs officer in any country, but let's just stick with the United States here, a customs officer will receive that manifest and look down the list and see what you're bringing in. And let's just say now that there is a tariff on Nike sneakers. This is not levied on the producer of sneakers. Like there's no payment made when they put them on the boat and they send them to the United States. It's only when that ship goes to unload those sneakers at an American port, the customs officer will say to that ship captain, "Oh, hey, hold on, guys. You're bringing in Nike sneakers. Those are subject to a 10% or whatever tariff. You got to pay us that right now."
At that moment.
At that moment, yep.
Okay.
So that ship captain, that ship, and that's a company too. Nike put their shoes on a boat owned by some shipping company. Now this shipping company is going to make the journey for Nike to the United States. Now that's added to their cost to get those sneakers here. So if you're the ship company and you're trying to make money off of delivering shoes from China to the United States, included in your cost is the crew, because you got to have guys on board the ship to make sure everything gets there. Fuel, because you're going through the largest ocean on the planet. You got to make it from A to B. And now also a tariff by the Americans once you land in the United States. So then those sneakers have had that cost added to them. Let's just say then Walmart buys a large portion of those sneakers to sell them to its customers. Walmart sees what it paid for those sneakers, which includes effectively a 10% markup because they had to pay a 10% tariff when they brought them in. Now Walmart's in the position to say, oh, well, yeah, I could sell them for what normal, quote unquote, market price would be, because that's maybe what everyone's expecting the cost to be. Maybe competitors are around that price. So I could eat that tariff. I could absorb that and take perhaps a 10% less of a profit or eat into my profit on that sneaker. Or I could say, you know what? I'm just going to let the consumer pay for this tariff and add on that 10% right onto the sticker price and pass that off to the consumer.
So in your analysis of that either gets consumed, that added cost, that added tariff either gets consumed by the end retailer, they take a depression in their profit margin, or tacked onto the price to the end consumer to pay it.
Exactly. And I really want to beat this to death. Even think about it just legally here too. The United States has instituted a tariff. A tariff, by definition, is a tax on imported goods. The United States doesn't have the authority to tax people sitting in China. So the only point of contact that you would have to levy that tax is as soon as it gets here.
Right.
So it is false to say that the Chinese or the Indians or the Europeans are paying these tariffs. American consumers are paying these tariffs. American importers are also paying these tariffs and either, as you said, passing the cost off to the consumers or eating it and hurting themselves.
So it's not paid by the exporter, the importer and the end user is paying it.
Exactly.
Yeah. I got to add to that. So the Federal Reserve has done the most recent example of real life tariffs prior to this year was 2018 during the current administration's first term.
Yeah.
They implemented a tariff on imported washing machines.
Yeah.
And the theory was we want to protect manufacturing and jobs of washing machine producers, domestic washing machine producers in the United States.
Yeah.
So they did an import on imported washing machines, thinking that it would help bring back manufacturing, raise demand of U.S. washing machine producers. And in reality, this is why the Fed studied it. In reality, it created a pricing ceiling for domestic producers to just raise their prices right up to the new tariff-enhanced number that importers were. And also, the administration chose not to do it on dryers, but because when most people go to Home Depot or Lowe's and when they get a new house and say, we need a washer and dryer, they saw it as an opportunity, they being domestic producers saying, hey, they're in there, let's raise the price on dryers too. So what they found is it did not bring back any manufacturing.
Yep.
It did not help create more sales necessarily, more units. All it did was put a tax on the consumer in the United States.
I think that is such a great example to drill deeper onto, and especially to the client question that we get all the time of, isn't this just fair? Isn't it unfair that all these other countries have tariffs, and aren't we just doing it back to them?
Most people see it that way, that we're just giving it back to them.
I think objectively speaking, if you were going to make an argument in favor of tariffs, I mean, reading through the lines here, you and I are not in favor of tariffs really in any sense, but reading through an argument you could make in favor of tariffs is if you are a nation, let's imagine you're some country, not the United States, and you're trying to develop your industrial base. You want to make washing machines in your country. But that's a lot of time to build the infrastructure to build washing machines and also train the employees to build washing machines. And that time In that time, the Americans, the Chinese, the Canadians, whoever are already selling washers and dryers on the global market. So you may institute a tariff that has the effect of raising the price of that imported good so that your domestic manufacturing has time to develop. So in the example of washers and dryers here, let's just say you're some South Asian country that is underdeveloped and you want to build out your industrial capacity. You're having a hard time competing with Chinese and Indian washers and dryers coming into your country. So you add a, let's just say 20% tariff on those imports. To your point, because your domestic manufacturing is not as good as the foreign manufacturing, it makes it more expensive to manufacture them domestically. Your people just aren't as good at it. Think about that with anything. The better at something you get, the more experience that you have, the faster that you can complete a task. That's very observable in manufacturing. The opposite is true too. The less time and experience you have in the task, the worse you're going to be at it. So naturally, in this example, a tariff is a good defensive measure, but it is temporary. Yep. Because in that time, while your manufacturing base is developing domestically, that does come with the obvious acknowledgement that you're hurting the consumer in the meanwhile, because you've made the cost of washers and dryers more expensive in the short term, with the goal being eventually domestic manufacturing will be as good or better than what we're buying on the international market, and it'll be cheaper for everyone.
Yeah.
So long story short, if a good reason to have a tariff is if at the end of it, your domestic manufactured goods will be cheaper to your domestic consumer than they are currently paying for imported goods.
Okay, to carry that one point further, a lot of people believe if we put a tariff on, we artificially raise the price.
Yep.
It's going to drive demand for U.S. manufacturing. It's going to drive supply for U.S. manufacturing. Manufacturing is going to want to come back to the United States. Your thoughts on this? People made the same kind of argument in different time periods. So if you go back to the 1900, 40% of the U.S. economy, like workforce, was farm-based.
Yep.
Today it's less than 3%. Those people went to factories.
Yep.
1950, when the manufacturing base in this country was 40%, today it's around 7%. It's just an evolution. Like you and I talked about this the other day. We've gone from farming to manufacturing to service, and the 7% now that work in manufacturing, we talked about that's probably going to be lost, a large portion of that in the next big block of time, to automation and robots.
Yep. Yeah, this goes nicely into the other topic we're going to discuss this episode, but that's not coming. The assembly line, as I think many envision it, as it was in the 30s, 40s, 50s, and 60s, is not coming back anywhere. Like, that's just not coming back anywhere. Like, we as a species have developed technology to improve manufacturing with the help of robotics and computers, so that there's no need for as many human hands on an assembly line as there needed to be at one point.
Even China is doing that. There's a measure called robot density. So they look at how many robots per 10,000 workers. China themselves is losing manufacturing jobs because they're automating it.
Yep.
Yep.
I don't think as a result of the tariffs I don't think that the tariffs will cause domestic manufacturing to resurge like the administration thinks it is. I don't think it's really even going to have a significant impact on domestic manufacturing. I do think there could be some growth in domestic manufacturing, if I'm being honest, not because of the tariffs or because anything, frankly, that this administration is doing, but just because it is actually now so cheap to manufacture. The reason that everything offshored in this country was labor in this country was more expensive than it was everywhere else. Now, computers are cheaper than that foreign labor.
Yep.
So maybe instead of building your plant in China where they're just going to do robots there, maybe you do build it in the United States. If it's just going to be robots here or robots there, why don't you just do it close to home?
Correct.
So I think that point to the AI, machine learning, and the automation of industrialization will boost manufacturing here, but it's going to be in spite of tariffs, I think, too.
Okay. Which is probably why the market is up double digits this year, despite having to deal with this threat that wasn't foreseen a year ago.
Yeah, I remember answering the phones on Liberation Day, talking to clients about that. The market, I don't think a better word than panicked could be used to describe the attitude. Really, it just wasn't his announcement like right at 3:30 or 4 p.m. too?
At the market
close. Like the after hours market was crazy. Like it was just, like you say all the time, an unforced error, chaos. And we're up on the year since, but
we went down 20% that day over the next month. Yeah.
Down 20% to get there. Besides the, definitional how this is hurting us, these tariffs, another externality of these tariffs is they create a uncertainty in the market. Yeah. Because they're changing all the time. Donald Trump is very technically acting under the International Economic Emergency Powers Act, which is right now being argued in front of the Supreme Court as whether or not he has this broad sweeping authority. So I think the fact that they're arguing whether or not he is allowed to do this, the rates change on the hour. He puts out a tweet on Truth Social and it changes. All of that uncertainty as a business owner makes it very difficult for you to forecast your cost. If you're importing anything into this country, your cost structure may change wildly week to week. How do you quote a job or anything if your costs are completely variable like that?
Just read about restaurants are terrified of losing customers because beef prices are up 18%. How they can pass that on without scaring away their clientele. That's their cost structure because of tariffs.
Yeah, it's not good as a consumer. It's not good if you're a business owner. It's just this. It's not unfair, regardless of what the president says. It is not unfair. So
to the end consumer.
To the end consumer, that is. Yeah, it's just. I think there's a lot of confusion out there, and unfortunately, this unforced error has caused a lot of pain in the market. So, circling back a little bit to AI, we mentioned machine learning there a little bit, but another question we get, I would say a lot, maybe a month ago, and it's already petered away, is the quote-unquote, are we in an AI bubble? Is this an AI bubble?
Incessant. What's the word? Incessant?
Incessant, yeah.
On every platform you go to read about, it's AI bubble. AI is overextended. It's just, you can't get away from it. Again, just on the surface that everyone's talking about it, I wondered if it's a known unknown.
Yeah.
But go ahead.
So, again, real basic, what are people talking about here? And I think one of the most fascinating things about this quote-unquote bubble is the Magnificent Seven. And those are companies everyone's heard about. That's NVIDIA, they make graphics cards. Meta, that's Facebook and Instagram. Google, Apple, Microsoft, Amazon, and Tesla. All of those companies are either developing their own AI or are developing the physical infrastructure to run their AI systems on. Or maybe even developing end products for the end user to find a way that these chatbots or something can work.
So on that point, this past quarter, this most recent quarter in September, that group, they call them in other ways the hyperscalers, the one plowing billions of dollars into that development. They put $100 billion into chip or infrastructure development for AI in this most recent quarter, which is 3 times inflation adjusted the cost of the Manhattan Project when developed the atomic bomb.
Yeah.
Just in the 3-month period. So, yeah, it's a lot of money going into this.
It's a ton of money. And I think that fact alone, like the scale of it, I think is very frightening to people. It's just, and because many of these names, Microsoft and I think Google were part of the tech bubble back in 2000. Definitely Microsoft.
Microsoft, yeah.
There's somewhat of familiar faces here again at the top surrounding all of this spending. I think it, maybe to the average investor, is frightening because of how many symptoms are similar. Lately, you and I have been talking to fund managers at BlackRock and Vanguard to look at our model and see how we compare. And one thing we heard that was very enlightening from them on this topic is the leaders of the tech bubble in 2000 were less cash flush than the Magnificent Seven are today.
Yep.
Meaning the Magnificent Seven today have more free cash on hand, not tied up in some debt obligation, not tied up in physical capital, cash in the bank today than they did back then. So they're not illiquid. Also, another graph we started showing clients in meetings is these companies are better financed. Their earnings are better. Their forward PE ratio is their 24-month forward PE ratio is less than the 24-month forward PE ratio of the tech bubble leaders back in 2000, which tells us that investors are a little bit more cautious of these seven today.
Yeah, if I want to jump in for a second on that. So I remember in late 99, remember the tech bubble burst March of 2000. So the year and a half before that blow up, the NASDAQ, which is primarily tech driven, the NASDAQ was up over 200% in a year and a half. And at the height of it, it just kept narrowing and narrowing, that the only thing that was working was anything with a .com, like pets.com, literally had an IPO, raised like $80 million. 8 months later, bankruptcy. eToys, same kind of thing. Launched, bankrupt. Like it was all momentum and hype. There was no, to your point, there was no cash flow. There was no earnings. There was no fundamentals to pay for it. It was just, it's internet related, and that's what I want. Everyone was just chasing it. It was like animal spirits, just thriving for it. Where now, I guess what we're hearing and reading and what you're saying, echoing, is the most profitable companies ever in humankind are plowing billions of dollars into something to become even more profitable, and they have the cash to do it.
Yeah. And further, I would add to that, I don't think investors are as wild.
Right.
Like you use the word animal spirits. I don't think there are the same animal spirits chasing the cost of these Magnificent Seven today. It seems, given the fact that their forward PE ratios are a little bit depressed in comparison, I think investors are a little bit more bearish on these companies today than they were back then.
The biggest company in our portfolio, biggest company in the planet, biggest company in the Standard & Poor's 500 is NVIDIA.
Yeah.
They're trading at a price to earnings. So their earnings, there's a price multiple that investors are paying looking ahead.
Yep.
In the 30 times, somewhere in the high 30s. So for every dollar in earnings, they're paying $30 in stock price today. Netflix is trading in the 30s, a stock that no one thinks is bubbly. Like at the peak of the tech bubble, Cisco and Oracle were trading at 100 times earnings.
Wow.
It's nowhere near that.
Yep.
And NVIDIA, I think their earnings are up like 60% from a year ago. They're up like 200% from 2 years ago. So it's not at all apples to apples of just momentum and hype compared to, they're dropping billions of dollars, but they've got hundreds of billions to do it right now.
Exactly. And I think that really all there is to say about this moment in economic history, if there is anything, is it is unique that such incredible wealth is concentrated in these seven companies. That doesn't happen very frequently. So that is obvious something to note. But the products that they're ultimately trying to make, AI development with all of this billions that they're dumping in investment, who's to say how this goes? They are building highways for the future. I think there's so much money being spent on AI development now because no one really knows what finally is going to be the spark that becomes the product that is the next billion-dollar idea with this. I think they're just trying to plow as many fields, turn over as many stones as possible to get there as fast as possible.
When you said that, so no one knows exactly how to apply this.
Yeah.
Just thinking about this conversation, I was thinking in some ways, maybe like my grandparents, maybe my great-grandparents, more likely my great-grandparents' generation, It was equivalent to the railroads when everything was horse and buggy, and then the rails came and connected. They created commerce and transportation, and they made the world smaller, the United States smaller. But almost with every technology, the automobile, railroads, the internet, now AI, it's like the real profitable use of it can't be seen in the initial development. And I was thinking about when I was a kid, this time of the year, I'd have the Sears Roebuck catalog with stickers all over all the toys I wanted. That company's gone now.
Yeah.
But Richard Sears, the guy that founded it, was a telegraph operator in the 1886 in Minnesota, working along the railroad lines, and a box of high-end watches showed up at his train station, and they were not, the jeweler that was going to sell them wouldn't accept the package.
Wow.
So he contacted by telegraph the manufacturer, and they said, just try to sell them. Don't send them back, try to sell them. So he marked them up and sold them. That's when standardized railways were using time, and it was very important the trains were on time. So watches were a great commodity. He made a lot of money, kept doing that, started doing it with other products. That's how Amazon 1.0 started.
Yeah.
So we didn't know that at the time. Actually, Sears Roebuck became more valuable, multiples more valuable than the railways that they used to transport it. Wow. So who knows where this is going to go?
Yep.
I use it to just ask it questions, and even asking questions, thinking about this conversation about how many jobs have been outsourced to robotics in China. And it showed me when I was on ChatGPT, it was showing me all the sources that it went to all over the world to try to get the answer. Like that would have taken me forever to do that, looking through periodicals or even just on my own research a year ago. So we don't know where it's going to go.
Yeah. I like using my own brain for the research, but whatever, man.
You can.
Last topic we really wanted to cover, and this is recovering old ground, is we wanted to take one more punch at crypto because it's just so fun to take a punch at it.
You really, geez, you called it. I hate to say we don't time the market. We don't think anyone can.
Yeah, but if you're calling bottoms in the crypto market, a broken clock is right very often in this case.
Really called it. That is fun to see what's happened.
Yeah. I think you have the exact numbers on this, but since we recorded that episode, when? Was that early summer?
I think it was it was early summer.
Early,
yeah.
May, June, we recorded that.
Yeah.
Since then,
because I remember we were at a family wedding and we were asked, can you talk about crypto? And we said, not today. Yeah. We are not destroying the weekend here talking about
I'm
crypto.
not billing.
But it was right
weekend.
after that. Yeah.
Yeah. So since then, I think you've got the numbers on this, but hasn't there been 2 busts?
One kind of steady grind lower, but I think Bitcoin from its high this year went from 126,000 around 80. It's recovered a little bit from there, but it's down, 25%. Ethereum's down 30%. Dogecoin is down almost 50%.
You're not tracking the spot price of the Trump coin?
I do not track that.
Yeah.
The global crypto market in October, from just our research that we look at, was valued at about 4.3 trillion.
Yeah.
End of November, lost a trillion. Lost a trillion.
God.
And it, again, as we talked about in our last podcast, it's there's no fundamentals. Unlike when we're talking about AI, there's no earnings, there's no cash flow. It's just you're betting on someone's going to come along and pay more than you are, only because they're going to think they can sell it to someone that's going to pay more than they did. That's what it's based on, as you define.
A lot of bag holders this year.
Yeah.
It's just, I don't know. I maintain some level of optimism about the tech. I think the blockchain is fascinating, but I'll be honest, it just sucks to see that the only thing that this is being used for is like crypto rug pulls scamming people out of money, or now like online gambling.
A lot of that.
Just so sad.
A lot of momentum, a lot of leverage, people borrowing money to buy it, to chase the momentum, and then when they get a margin call, the dominoes just fall.
Yep. I mean, that is gambling too, but I would also mean like literally like sports gambling and stuff now using.
Oh, you can use crypto.
Yeah,
to do
using
that.
crypto to do it. It's just sad all around. But that's really.
So all three of those, tariffs, AI, the concern over are we in a bubble, should we get out, tariffs, should we get out of the market with this trouble coming over the hill, I think that all, and crypto is a deviation from investing in equities of can I get a better return, all of those take the foot off the gas pedal.
Yeah.
Which we talk to clients about all the time. 2 years ago, one of my favorite commentaries on investors, Warren Buffett's old partner, Charlie Munger, died.
Yeah.
And his saying was never interrupt the compounding, and everything that you do is an interruption to it. Just think about taking the pressure off and being out of the market. Even this year, if you're out of the market saying the tariffs are going to destroy us and we're in a bubble,
Yeah.
the S&P is up more than 15%, 18% almost year to date with all that trouble brewing.
Yep.
Like that's nothing you can ever get back.
Yep.
So that just goes to our mantra of missing out is more costly than trying to time it because it can't be done.
Yep. Absolutely.
So one thing you and I talked about this before. Have you ever heard of I don't know if you heard the name of it. It's called The Legend of the Chessboard by Sissa.
Yeah.
You know that?
I've heard of it. Yeah. Yeah.
So correct me if I'm wrong on this, but the myth is there was this Indian servant that discovered the game of chess. It's not true, of course, but it was probably developed in Europe.
I don't know.
So this Sissa developed it, presented it to the king, who loved the game. And the king, who was an oppressive ruler, said, I'm going to give you a reward for developing this great game. What can I give you? And Sissa, understanding math, there's 64 squares on a chessboard, said, I would like a grain of rice on each checker or each piece of the board, each of the 64 spots, but double each piece each day. So day 1, I get 1, day 2, I get 2, then 4, 8, 16, so far. And the king's like, oh, 64. Yeah, sure. Great. That's easy.
Yeah.
So by day 20, you're at 500,000 pieces of rice from doubling. Day 30, 500 million. Day 40, 500 billion.
Yep.
You're not even at the end of the board yet. By the time you get to the end of the board, it produced more rice than was ever produced in the entire world at that time. So you back off of that by one day and you miss it all.
Yep.
That's the whole point of, you said it in meetings this week a couple times of pointing the nose.
Yeah, yeah. Why would you point the plane of the nose down unnecessarily? Just keep it pointed up.
Yeah, never.
I think the best part of that story, though, the chess story, is that it's just like a failure of auditing. Like no one in the king's court at any time was like, maybe we count that up first and see how much that is.
Before you
they
commit
just
to
fired
this.
it off. Yeah, before you lock in on this, maybe we count that. But either.
Absolutely.
Yeah, great story. And that's a wrap on this final episode for the 2025 podcast season. We are looking forward to next year, where we will talk about some other new and exciting topics and developments in the market, as well as bringing video to these podcasts as well.
How about that? So Generation 2.0, you're going to be able to see us, hear us. Should be fun.
Exactly. Thanks again for tuning into the Fiduciary's Edge. We're on a mission to teach people how to avoid herd mentality by focusing on the decades rather than days. If you want to learn more, watch out for our quarterly newsletter and podcast. And as always, all views and opinions expressed in this podcast should not constitute financial or legal advice. Past performance is no guarantee of future results.